Thank you for joining us for this quarter's Observations in Global Equities and Fixed Income. My name is Adam Sparkman, and I'm a client portfolio manager with Thornburg Investment Management. Today I'm joined by our co-heads of investment, Ben Kirby and Jeff Klingelhofer. Jeff, Ben, thanks so much for being here today. I think we'll start off with maybe one for both of you. So the yield curve has inverted sharply over the past year. PMIs have remained below 50 now for 10 months, and many other leading indicators have been flashing red for what seems like most of 2023. So despite all these signals, where's this recession that everybody's been expecting?
Yeah, I think coming into this year, we certainly expected a much slower economic environment, lower growth. And I think a number of the signals that you point out, if we don't see a recession this time around, it will be the first time in history that many, or even individually, any individual one of these indicators has failed to ultimately lead to a recession. Now, that doesn't mean it's going to happen, but certainly not just taken individually, but cumulatively, all of these red flashing signals hasn't led to the slowdown that we expected. And so I think where we stand currently, certainly where I stand currently, is we need to continue to look towards the future. One thing I've talked about very recently is the alchemy of low rates, I think, is over. The low rate environment allowed consumers to pull forward a lot of excess demand, allowed corporations to term out their debt, for individual consumers to term out their debt in the form of long 30-year mortgage rates, et cetera. I think what this means is the impact of higher rates isn't different this time around. What is different this time around is the length it takes for those rates to really have the bite to slow the economy. And we're starting to see that now. We're starting to see a lot of economic indicators turn down, certainly not to current recessionary levels, but I continue to believe it's around the corner and preach caution.
Ben, how about you?
Largely echo what Jeff said. I think that it takes a while for tighter monetary policy to work its way through the economy. So, look at home affordability. It's at a 40-year low. That's really quite exceptional. It's hard to buy a house today because prices have gotten elevated and interest costs have increased a lot as well. The cost on a monthly basis of buying a new car is up 30 to 40%. So volumes of cars and autos are slowing significantly. That's just one example of how higher rates is taking a little bit longer to work through the economy, but eventually it will continue to slow things.
So Ben, international stocks have lagged those in the US year to date, despite showing some pretty durable performance during 2022's sell-off. We've talked about, really for a while now, that valuations outside of the US certainly look attractive. Do you think that international can finally catch some performance momentum?
Yeah, what's interesting about international stocks versus domestic is the international sector doesn't have the 10 big mega cap companies that are inventing AI and sort of changing the world in those ways. If you just look at the other companies, so look at maybe the S&P on an equal weighted basis, which is just a backhand way to de-emphasize those mega cap companies, earnings growth for the S&P equal weighted has been very similar to earnings growth for the European indices over the last couple years. And yet, even though you've had similar earnings growth, you've had about 13% return in European stocks and about 35% return in the equal weighted S&P. So you've had a lot of multiple expansion in the equal weighted S&P. I think that's one of the opportunities. Certainly valuation is compelling, but you're also seeing still very reasonable earnings growth out of the European and international companies in general. I would add to that currencies, which are not a great predictor of near-term returns, but on a long-term, currencies tend to mean revert. And they tend to mean revert to something called purchasing power parity, which is just looking at the price of a good in one country for exchange rate should be the same in another currency. And on that basis, the Japanese yen is about 40% undervalued, and the euro is about 25% undervalued. So the dollar is expensive versus those currencies. The Brazilian real is about 40% undervalued. The Chinese renminbi is also undervalued. So the dollar is strong. So to me, a big part of the case for international diversification right now is earnings growth has been very similar to the equal weighted S&P, and the dollar looks relatively strong versus history. Those things tend to mean revert over the long term.